Welcome into another Emerald Financial Podcast, guys. My name's Tim Michaelides. I'm joined here today by Michael Cornups.
Good morning.
Good morning. All right, so the topic of today, important topic for markets this year, is inflation. Okay, so as we know, we're seeing prices go up everywhere, CPI readings coming in higher than expected overall, and it's heavily affecting the mood of the market. Now, before we get into the topic, guys, just please, like our videos, subscribe, leave us a comment, good, bad, or other. Would love to hear from you guys.
More good, less other.
Yes,
if you could.
All right, so inflation, hot topic, very important for what the market's going to do next. Mike, do you want to kick us off?
Yeah, I think the main issue in our financial markets is the direction of interest rates. The Fed obviously aggressively trying to dampen that with lifting interest rates. Various countries, New Zealand, already above 2% on their interest rates. Canada, Australia, we're expecting, the RBA meets next Tuesday, don't they? So expecting 0.5%.
Correct.
The US meets Wednesday their time, so tomorrow we'll find out. 0.75, I think we're expecting.
That's the feeling I'm getting as well.
Yeah. And the way the Fed talks is aggressive, and the rhetoric they want to get out there is they're going to kill inflation with higher interest rates. And the bearish talk, I think, is affecting the market.
No.
And what we're really trying to do today is say, look, whereabouts are we on interest rates perceptions, inflation, and is there a light at the end of the rainbow?
And where does the opportunity lie moving forward, right? So
exactly.
That's what we're here to do.
Yeah. So I thought let's put up a graph of the bond rates. Looks like a lot of lines there, but pretty much they're bond rates for the last 6 months, from 1 month rates right through to the 30-year bond. And really that picture tells the story. If you look at those top lines there, the longer term rates, and you can see they quickly lifted up to that 3.5% level, but it really has since gone sideways. So the peak of 3.5 seems to the pressure's come off that, and I think the impression is that inflation will come under control sometime next year. Those other shorter term rates, you can see as the longer term rates have gone sideways, pretty much all the short term rates up to 2-3 years have just done the catch up to that 3% level. The question the market asks itself, is the terminal cash rate going to be 3%? Now, we expect it to be 2.5 to 3%. The Fed is still talking bearishly. They haven't taken any pressure off that conversation, but the terminal rate is 3%. Is 3% enough to kill inflation? We expect so. The market, I think, is looking that inflation is under control. You think, Tim?
Yeah, we're definitely seeing a lot of signs of that, that's for sure.
Yeah. So what we can do with the bond market is track the implied inflation rates. The bond rate tell us. And pretty much we've seen that inflation rate really it's peaked up there, and it's come down. The implied inflation rate, the market believes the inflation rate has come down at 1% from the peak of where they thought it was going to be a couple of months ago. So those implied inflation rates, for the 5, 7, 10, 30 year, is the market is telling you, look, we've got inflation under control. Now, that is saying, well, look, that's looking forward to middle of next year, but today our problem is cash rates are in Australia it's 1.35, and we expect it to get up to at least 3% by Christmas, and at one stage they thought it was going to get to 4.5%. Now, the thing, of course, is that interest rates, I think, for the general person is about the money that comes out of your pocket. So if your mortgage rate's based off a current cash rate of 1.35%, you're not feeling as much pain as when it physically goes to 3% at Christmas and your mortgage rate is 5.5% to 6%. With higher house prices and higher interest rates, the average person is starting to feel it. So I think the market at the moment is trading perception of what's going to happen by Christmas. But then we've got these financial markets, those rates, inflation rates, middle of next year. I think there's a bit of a ray of hope out there somewhere.
Yeah, this is the first bit of light at the end of the tunnel I've seen in quite a while.
Yeah,
since January, when the Fed came out and started changing their tone towards rates and what they thought inflation was going to be.
Yeah, so the Fed expectation, we hope, is a hard 0.75 increase. Don't believe they'll do 1%. But I think the 0.75 increase, and will there be a softer tone on the hawkish rhetoric to say, okay, guys, here's what we're looking for, and we may change our mind. With some slight softening, which will give the market some hope.
Yeah, it's a hard one because, the last CPI reading in June came in higher than expected again, right? So if you're just purely looking at CPI, well, the Fed can't take the pressure off yet. But if you start looking at what the smart money's saying, and that chart's telling you what the smart money's saying, that inflation's coming down, will the Fed take notice of this, or will they stay on their hard line approach until they see the CPI reading come off?
Exactly. And you've pointed out a couple of times, Tim, like you got oil prices at $100. Okay, so there's inflation in the $100, but for the inflation to increase to be the same next year, it's got to go from $100 to $110.
Correct.
Now, so if it's $100 next year, it means inflation's zero. So even though the price is still high, so.
Yeah, and look, and what we've seen out there in the commodity markets is actually most commodity futures have fallen off dramatically, right? So wheat's back to pre-Ukraine and Russia war levels, okay? And most agricultural futures are, all right? So food prices pressure should come off a little bit. Metals, okay, so a lot of industrial metals like copper, okay, fallen 30% from their highs. So they've corrected down quite a lot. Only thing that really hasn't, and even crude oil came from US crude from 120 down to below 100. So most things have come down a lot, which helps lead to what you're seeing on the chart there. The one thing that hasn't fallen yet, though, or a couple of things, is in the energy space. You've got coal that's still sitting at all-time highs. You've still got gas prices that are sitting at all-time highs. So there's still a little bit of pressure there in the energy space, so utilities and things like that. Yeah. But everything else, the pressure should start coming off.
Yeah. So how you split up between coal and the other commodities, and I think what's happening there is that coal is a particular asset where Germany has pretty much stuffed up its energy plan, and the other way they're going to heat the houses is that they have to go back to coal. So that's put pressure on in particular on the coal supply. Gas has gone back up again because the Russians have pretty much closed down the pipeline. So coal and gas are up in particular. But the other commodities you mentioned, copper, especially gold, but have really come down that hard 30%. And the commodities like copper is like a health of the economy type commodity. And if we just pop over the next slide, if I can, no, I've picked the wrong slide. The slide in front of us is a yield curve inversion. So pretty much the bond market picks a recession when the short-term rate is higher than the 10-year rate. And with those lines going below the zero line, it means the 2, 5, 7, 10-year rates are all inverted. And what that means is that the economy is expected to slow down. There is a recession that is predicting a recession. So therefore, it hits the growth commodity stocks, the lithium, the copper,
correct,
and coal and gas has got its own life, hasn't it?
Yeah, correct. So this is just really highlights what the Fed's doing, because prior to the Fed changing their tone in January, the yield curve was extremely healthy. coming into this year. And we were expecting to have a sort of a bumper year this year, weren't we?
Yeah.
And then all of a sudden that changed coming into that mid-January where the Feds changed their tone to, this may not be transitory. We've got an inflation problem.
Yeah. So the big picture is that the market's predicting that the inflation levels have come down 1% from their previous high, the expectations. So the Federal Reserve needs to slow down the economy. It looks like it's happy for a recession.
Yep.
And if there's a recession, we're seeing the evidence of it in these inverted yield curves.
Correct. So I would not be surprised to see another negative quarter of GDP growth come Friday morning, based on what we're seeing here.
That's right. So, and the last slide I just wanted to talk to was, the Fed is aggressively saying that they're lifting interest rates to slow down the economy, and they promised us quantitative tightening to take some money out of the system. But this graph from the very excellent Fred St. Louis database shows the size of the Federal Reserve balance sheet. And as we can see over the last month or two, at the end, the Federal Reserve is not doing any QT. They're doing Q without the T.
Yeah. It's kind of amazing that sometimes they just blatantly don't do what they're going to say they're going to do.
Well, I reckon if that was on a downtrend, that line, the S&P would be down another 10%.
Oh yeah, absolutely.
So I think that to me is a little bit of a conflicting signal. So out of all that, I think what the market's expecting through these lower inflation rates, or lower interest rates as well in the middle of next year, is that, we're waiting for the Fed to change their mind.
Yep.
We've done too much damage, and then we're looking for easier monetary policy. There's no QT, and if interest rates are either stabilise or come down, that's the light at the end of the tunnel.
Yeah, that's definitely your more bullish case for the market and recovery case for the market. So let's try and simplify this message, right? So let's talk the bull case and the bear case. So your bull case for the market moving forward, obviously, is that inflation starts coming down. These expectations are showing that we're seeing light at the end of the tunnel there. But ultimately, what we want to see is central banks, particularly the Fed, which is kind of the leader of the group, to start changing expectations and sort of go neutral, right? They're front loading at the moment. We want that front loading to end, and some kind of commentary around, okay, we're sort of at a neutral stance or a little bit above a neutral stance. We're going to stop for now and see what happens, right? Because if they don't do that, that's your bearish case if you see the US go into a recession. You've got to think about this for a moment, right? You've got a recession and then the Fed continues to lift interest rates aggressively. Has that ever happened before? Like that's
well,
blows my
a
mind.
lot of people are saying this is a policy mistake again. And I'm sort of in agreement with it. The problem for the Fed, of course, is a very tight labour market in Australia and the US, so that 3.5% level. If our unemployment rate goes back over 4%, our reserve will start to think again. But these low unemployment numbers are the catalyst for the higher rates. So the dual mandate for the Reserve Banks, Australia, US, is full employment and stable financial system.
Yeah, price stability, yeah.
So, all right. So in terms of how do you think we should be playing this from an investing point of view?
Absolutely. So coming in a little bit early with this view, guys, okay, and obviously I'm still waiting for a little bit more signals on the market before I actually trade this view. I guess what I'm doing right now is getting my shopping list ready because at any point in the coming weeks, days, months, this view will come into play, right? So when the market narrative starts pricing in that interest rates have stabilised and they're going to stop lifting rates, I believe you've got to start looking at the beaten down discretionary and tech sectors. We've already seen a little bit of life come back into those sectors in the previous month, and that's actually played in roughly the same time as these inflation expectations have been ticking lower. So I'm particularly interested in tech and discretionary, and that's because they're the two sectors that have been pricing this move in the longest, right? So they've already, for me, priced the recession in. They've been falling since about March, even February, and they're falling a lot. Okay,
stocks are down, 70-80% up.
Oh, summer, yeah, like it's crazy. Like JB Hi-Fi, Mike brought up to me earlier. That's fallen roughly 30% from its highs. When it was at its highs, it was still running at a very, very cheap price to earnings ratio. We had a sales update from them last week. Nice little run up on the chart. If you go have a look, their earnings haven't gone down yet. Okay, you're talking about a discretionary stock that's doing extremely well, positive earnings, has fallen because of recession fears. So you'd have to start speculating that they're going to bottom out soon, especially if this inflation narrative starts changing.
Even the small cap stock, Harris Technology, I mean, they came out with their cash flows, so all the quarterly 4Cs are due by Friday. They came with the cash flows, so they've just... slightly positive cash flows. So for another discretionary stock, they seem to be getting through.
Yep, absolutely. Now, I have to remind you guys that we're in a different marketplace to where we were coming into that recovery of COVID. When we were recovering from COVID, there was a lot of stimulus and a lot of money being splashed around. So you could almost go buy anything, right? Now you've got to be selective of what you're going to buy in these sectors. I wouldn't mindlessly just go out and buy anything in that
And what's
sector.
your main benchmark filter? Is it EBITDA?
Definitely positive EBITDA is the key there for me, and perceived future growth. So one of my favorites at the moment is Microsoft, because basically they've got future EBITDA estimations as positive, plus 20% growth is what they're estimating for that stock over the coming years. But a little bit more recession proof as well. So you've got a quality tech company that's been around for a very, very long time, that's heavily sold off and looking quite cheap, sitting at about a 28 price to earnings. So it's very rare to actually see some of these NASDAQ type stocks this cheap, especially for a company that's got future growth perspective. Okay, so you've got to have something like that on your shopping list that's fallen quite a bit, starting to show some signs of bottoming. Time your entry though, guys, because as we know, coming into Thursday, Friday with the Fed and that GDP reading, there could still be a bit more volatility here. All right, so timing's the key, but definitely get your shopping list ready. All right, things like Microsoft, things like JB Hi-Fi, Wesfarmers, for instance. Okay, also a very good earnings stock that's fallen a lot since the beginning of this year.
And obviously the companies with the cash burn, and you see them, they burn through their cash and they get down to a low level, and they have to come to the market for a cap raise or some debt issue that they get put under pressure. And this is probably not the best market to be trying to raise capital. No. And the thing is that if you've been raising capital last year and your price has fallen 80% and you have to raise more capital at an 80% discount, well, like it's just it's not good overall for you as shareholder.
Yeah, so if you're going to sort of play around in that negative earnings space, a bit more speculative growth stocks, you definitely want to be getting into one that's a bit more cashed up. So PointsBet, PBH be one that you want to have a look at. Raised capital not that long ago, has fallen off highs of $16, got as low as $2. Starting to show some interesting technical signs of bottoming out. So if you want something a bit more speculative in the growth space, I'd be looking at something like PointsBet that hopefully won't have to come to the market for capital for a little while, and that's just been completely beaten down.
And the other sector, of course, you got this copper at ultra low prices. The theme for the next 10 years must be the environmental green movement. The Europeans are going... they've cut nuclear, they're trying to cut gas, they're trying to cut coal, and so money will come into those infrastructure to build green energy. So the base metals, I think, will be a popular investment. The money has to go in there.
Oh yeah.
And as I've kept mentioning, the environmental movement has dried up the capital for a lot of the exploration companies, so there's going to be supply side constraints, copper, lithium. So and the Europeans are 100% committed to build the infrastructure for renewable energy. And at this stage, why is copper down to the level it is? So
you can easily blame your central banks on that one.
Well, the Europeans will run into a deficit just to build their infrastructure. So I think we're seeing some good prices on commodities.
It's coming. Yeah, I think if you're not in that space, you've got to be watching it this year. Get your bottom and start looking at some of those definitely future metals and copper stocks.
Yeah, and it's interesting too. The BRICS countries are getting a bit more organised. Brazil, Russia, India, China, and South Africa are forming a trading bloc. Doing agreements. There'll be I think the attitude there is to try and move away from US dollar settlements. Somebody was mentioning the other day, even BHP is settling in yen with China. And Russia obviously has been forced to move to a gold settlement into Russian ruble settlement. There is what this COVID the Russian-Ukraine has shown is that the US will suspend your US Treasury investments if they don't agree with you. So, and whether that's right or wrong, sort of beside the point, it just means, are you keen on losing your money? No, let's find an alternative. So I think what will come out of all that is not another world currency like the US. China doesn't want to be world currency because there's too many restrictions that come with that. It'll be some sort of basket of currencies combined with commodities. Brazil could pledge their resource assets to a commodity basket. So you'll see something like that. But so what's happening now with the dollar index up around 107, 108? What that means, all the emerging countries who've borrowed US dollars are really hurting because they're desperate for US dollars. And the US dollars are also putting up their interest rates. So not only is the emerging countries' currencies gone down, the US has also got higher borrowing costs. So it's just not healthy to be based in US dollars as a long-term strategy.
That's also an alternate way for the sort of supply chain to move, right? So we're all worried about the supply chain with the Russia-Ukraine situation, especially in the energy space. Yeah. And I think one of the reasons why crude never got as high as what everyone was predicting was that obviously Russia was able to then deal with India and China direct. So this, for me, is also helps keep prices subdued and help sort of that inflation narrative as well.
And China has brought together all its buying of iron ore into one central agency. Yep. So now there won't be separate contracts going on, and I think the Chinese are probably taking control of the commodities they're buying.
Yep. Okay, so lots going on out there, guys, but all in all, we're seeing some light at the end of the tunnel on the inflation front overall. Obviously, there's still some areas where the supply chain needs to catch up, but I suspect in the coming months we'll start seeing the CPI readings, rather than beating expectations, start coming in under expectations and slowly coming off. And if that's the case, there's definitely some cheap stocks to buy on these markets.
Yeah, as opposed, say, to the housing market, I think I think it shows that the Australian economy has too much debt inside it. I think the house prices are too high, and a 3% cash rate gives us a 5.5-6% mortgage. Hopefully that'll bring some sanity to the housing market. I don't want to see house prices going off, but at least if house prices go sideways, instead of doubling every 10 years, I think it might be a good outcome, make a more healthy economy. Yep,
agreed. All right. I think we're done there, guys. Yep. So once again, thanks for listening in. Please shoot us a comment and a like. I will appreciate that.
Yep. And hopefully we can catch up again and say something interesting.
Yep. All right. Until next time, take care and bye for now. Bye-bye.